So investors are starting to ask this question: is this time different? So I won't pretend to know the future, but I do know what the past looked like. So the 2025 bull market today keeps getting compared to the 98-99 for a very specific reason. The same excitement, the same momentum, and the same new era optimism. And back then, it was all about the internet. And today, it's about AI, artificial intelligence. So both phenomenon has promised decades of change. In hindsight, the internet did change everything. And personally, I wouldn't even be surprised if AI did the same. And now, here's the more important and interesting development. So amidst many of such comparisons with the dot-com boom in the 2000s, a recent video on YouTube had gone essentially viral. It clocked in more than 1 million views in less than 2 weeks. And the idea being shared in the video, it's relatively simple. This is happening in the stock market again, and nobody's talking about it. And here's a quick summary of what the creator has shared. So history tends to repeat, and we always have investors telling themselves, this time is different. And Sir John Templeton actually called those the 4 most expensive words in stock market history. And Jesse Livermore, the legendary trader, said nothing on Wall Street is new. And both warnings actually point towards the same lesson. When people believe certain stocks can't lose, trouble tends to follow.
And there's a stock market bubble that nobody talks about anymore. It's a bubble that looks disturbingly similar to the current state of the market. I'm not talking about the dot-com bubble of the early 2000s or the 2008 financial crisis. I'm talking about a bubble you probably have never heard of. It was a bubble that when it popped, the damage was ugly. The market crashed 50%. Many of the world's largest companies lost 60 to 80% of their value. Inflation surged from 3 to 11%. And the market didn't fully recover for 8 years. I'm talking about the Nifty 50 bubble of the early 1970s.
Be honest, how many times have you heard of me talk about Longbridge Singapore? And yet, you're still leaving money on the table. So you're paying fees you don't need to pay, parking idle cash at near zero rates, and skipping stock rewards if you just follow a simple plan. First, if you sign up today, you get to enjoy lifetime $0 commission on US, Hong Kong, and even Singapore stocks. Second, you receive an exclusive 12% interest boost coupon for 90 days on deposits up to 2,000 Singapore dollars, plus an additional 18 Singapore dollars worth of cash coupon if you use my link below. And if you are aiming for additional stock rewards, the rules are pretty simple. Open the account, deposit, complete buy trades within the guidelines, and hold your funds. So on the first tier, you have to keep 2,000 Singapore dollars for 30 days and to make 3 subsequent buy trades. You then get to enjoy $40 worth of Nvidia shares and $40 of Apple shares. On the second tier, you deposit 10,000 Singapore dollars and maintain it for 90 days. 5 buy trades, you get $135 worth of Nvidia plus Apple. And on the last tier, tier number 3, deposit 100,000 Singapore dollars, keep it for 90 days, do 8 buy trades, and enjoy $385 worth of Nvidia plus Apple shares. So the rewards are not stackable, so pick your level and execute accordingly. And this special welcome offer is for new Longbridge Singapore users, and it is valid until the 31st of October 2025. And with this in mind, for my Singapore viewers, please go and grab your rewards today. And thank you Longbridge for sponsoring this video. So in the late 1960s and early 70s, the Nifty 50 was seen as one decision stocks. You essentially just look at them as just buy, hold on to them, and never sell. And these were big blue chip names like your Coca-Cola, McDonald's, Xerox, and Polaroid. As with all market bubbles, I think euphoria took control of the general investor psyche then, and the faith got pretty extreme. So while the overall market traded at roughly 15 times earnings, the Nifty 50, which is a group of 50 blue chip stocks, averaged at roughly 42 times earnings. And at its peak, the Nifty 50 group was roughly 45% of the whole US stock market. Then, in 1973-74, terror and horror struck. Oil spiked, inflation shot past 10%, unemployment jumped to a never-seen-before level, and the gold standard actually ended. And the market pulled back significantly, and the individual names essentially fell flat on its face. So some of these popular names that we know even until today: Coca-Cola, it dropped 60%. McDonald's fell 70%. Polaroid actually came down by more than 90%. And the entire recovery of the index took roughly 8 years. And it's not a quick V-shaped recovery that we are all accustomed to today in the past 5 years. And fast forward, today's version of the Nifty 50 seems like the Magnificent 7 stocks that cannot fail: Microsoft, Apple, Google, Amazon, Meta, Nvidia, and Tesla. And they currently comprise a third of the entire S&P 500. Sounds familiar, isn't it? So while the Mag 7 stocks are amazing companies, yes, but investors are acting like they're never selling again. And on a side note, you should never sell out the like button too. So make sure you remember to reel them in by smashing on it. And also, if you'd like to get a weekly ping from me on my latest thoughts and musings of the markets, so sign up for the free Substack newsletter in the link below. With that, let's get back to the video. When some of you look at the Mag 7 valuations at first glance, you might feel a tad bit uncomfortable. Uncomfortably higher compared to the general markets. But if you're to strip down the group and to judge them on an individual basis, it's only one company out of the 7 that looks outstanding with an inverted comma. In fact, they're mostly still trading in the range of the mid-20s to low 30s forward PE ratio. So are they cheap? Of course not. But is it really ridiculous for them to command this kind of premium, trading at roughly a 3 to 4% earnings yield? I don't think so either. Going back to the video, comparing today with the Nifty 50 in the 70s, what I'm generally more concerned about is when investors consume the video passively, following the storyline being constructed by the creator, and just take the information as it is, without putting in much thought, and buys into the same conclusion. Oh, yeah, humans are going to be greedy again, history is going to repeat itself, we are clearly in a bubble today, and let's just sell our positions and not participate in this quote-unquote stock market bubble. Instead, I think it's more important to identify the why and to exercise a strong independent judgment. So here's how I will make my case. So when we call the Magnificent 7 quote-unquote high quality, we should be clear about what that means. And to put things in a much more numerical, tangible, objective sense, on near-term revenue, the Mag 7 are expected to grow about 13.4% versus the 5.4% expected growth for the rest of the S&P 500. And that's more than 2.5x faster. On earnings, which is the bottom line, they are pacing at roughly 17.6% growth versus 12.5% x the Mag 7. And that's roughly 40 to 50% higher. And on profitability, their forward net margins is about 27%, compared with the 12.3% for the rest of the S&P. That's over 2 times more. So to put simply, faster sales, faster profits, fatter margins. With those gaps, I think it's not surprising that investors are assigning them, this group of Mag 7 stocks, much richer multiples. And the real question for us isn't whether they deserve a premium, but how much and whether today's prices already assumes those advantages persist. And the more important point that I hope to drive home is actually the second part of the Nifty 50 story. You have heard the first part. It's the scary version from the summary. So you have sky-high earnings ratios, a 50% bear market correction, blue chips being down 60 to 90% from peak to trough, even if they were once considered as never sell stock, and an 8-year-long lost decade. Maybe 2 more years to consider a decade. But you get my point, a very long recovery period. However, I think here's the part almost no one actually tells you when describing a market crash. Because it doesn't help the story that they're trying to portray. The aftermath. What happens after the entire crash landing? So Jeremy Siegel, which is an American economist and a finance professor at Wharton School, went back and asked a very boring but a very important question for investors. If you actually bought the whole basket of those 50 blue chip stocks during the Nifty 50 era at the worst possible moment, which is the 1972 peak, and simply just held onto them and rebalanced along the way, what actually happened over the next 26 years until 1998? Why that time period? I don't know, but he's published his findings in 1998. So an equal-weighted, regularly balanced Nifty 50 portfolio delivered roughly market-like returns from 1972 to the late 1990s. And here's the translation. even after buying at a peak, experiencing a nasty bear market, and losing essentially more than half of your capital, the long run actually paid you close to the index because the compounding of the steady winners actually outweighed all the blow-ups in the 50 names. So why did that happen? I think there were three main factors explaining it, of course, in hindsight. First, I think a universal principle in investing is true. Earnings growth eventually drives outcomes and returns. So the total returns formula can essentially be split into three separate levers. Earnings growth plus any dividends or buybacks plus or minus any change in the earnings multiple, essentially the premium that people are willing to pay. So the Nifty 50 cohort on average actually grew earnings much faster than the general markets for decades. And yes, the initial dividend yields were lower and some PEs actually fell back to earth. But the growth math actually kept stacking. Second, the asymmetry of investing. So the tech darlings of that previous era, which you have Xerox and Polaroid, etc., looked invincible and then disappointed and disappeared. But in a 50 stock basket, the worst a loser can do is to go to zero and to go bankrupt. But a winner can more than 10x their returns. And that specific asymmetry is why broad exposure plus time can rescue a less than ideal entry. And third, valuations were expensive, no doubt, but not across the board insane. So Professor Siegel actually ran a warranted PE check and to take what each company actually earned and delivered over the next quarter century and ask, what PE in 1972 would that have been justified? And on that basis, the group at the peak looked only slightly overvalued on average, then being undervalued for long stretches after the crash. And in other words, if you added from the fall, you actually easily outperformed the index. And after hearing this, the intuitive question is, what's next? So what? How do we use this to our advantage? So I do have a few grounded takeaways for this new AI era. I think first things first, owning real growth can work even if you were to overpay a little at the start, if and only if the business keeps compounding and you give it time to do the heavy lifting. That means to size your exposure appropriately so you can hold through the ugly parts and ideally spreading it across more than one winners instead of betting the farm on a single name, which might or might not turn out well. And it's also definitely not a green light to buy anything at any price. It's a reminder that time is your edge if the earnings engine is real. So in Professor Siegel's work, I think the pricier slice of the growth underperformed the cheaper peers inside the same group. So to the layman, simply put, it means to pay up for quality but not for fantasy. I repeat, it's to pay up for quality but not for fantasy. And a quick sense check helps. You stack up the company's expected growth against their earnings multiple, and if that trade-off actually looks skinny and it doesn't look in your favor, you're probably paying a little bit too much. And what actually drives good outcomes is explosive and, more importantly, sustainable growth at reasonable entry. And one last thing before we close this entire discussion. We often underestimate what we can do in a few months, and henceforth always wanting to take action, shuffling cash around, making tactical movements, trying to time headlines. And we underestimate what steady compounding can do for you over the long term. And clearly, as from this example, investing is much more forgiving than it looks. And even Buffett himself said that most of his edge actually comes from roughly a dozen great calls across a lifetime. Not hundreds, just a dozen. And back to the Nifty 50 example, Monish Pabrai, a billionaire investor, tells a similar story that makes the point. So there's a debate about whether Walmart was officially in that 50 stock group. But imagine that it was, and indulge in this thought experiment with me. So let's assume that you buy all 50 stocks at the 1972 peak, equally weighted at 2% each. And now, pretend that the other 49 stocks all go to zero, which I know it sounds ridiculous because you have other winners like Coke, but just stay with me for now. So from peak to trough, Walmart actually tanked roughly 80%. However, if you actually held onto Walmart from then until today, you would still beat the index over the very long run, even considering all 49 stocks going to zero. And so, here's how I leave it. In this AI charged market, your job isn't really to predict every wiggle. All you have to do is to own real businesses that can compound at sensible sizes. So let time do the heavy lifting and just avoid paying fantasy prices. You don't need to pick 50 perfect stock picks, but you just need a few great ones, bought well enough at a good margin of safety, and also to have the patience to not sell in the future and to disrupt the compounding pattern. So stay focused, and I hope to see you on the other side. With that in mind, I'll see you in the next video, but more importantly and hopefully, I'll see you guys on the moon. Goodbye.